Good morning and welcome to the 2025 Birmingham Bloomfield Chamber Economic Forecast. I'm Joe Bauman, President of the Chamber. On behalf of our staff, our Board of Directors and Ambassadors, I want to welcome you to our first major event of 2025. Before we get started this morning, I just have a couple of thank yous and introductions. First, though, however, by show of hands, who this morning is attending your first BBCC event? Awesome. Welcome, welcome, welcome. So for your benefit, I'm going to take just a minute and I'm going to introduce our chamber team. Kelly Bennett is our operations manager. Kelly checked you in this morning. Kelly. Annie Burns is our marketing and event manager. Annie. Layla Broughton is our membership engagement manager. Layla's over there somewhere. Megan Davidson is our videographer. And Michael Mackey is our intern. I also want to acknowledge a special group of chamber members who help us do everything we do. We have over 650 member businesses in the chamber. We have a relatively small staff, and so we couldn't provide the robust programming we do throughout the year without our volunteers led by our board of directors and our ambassadors. So if you serve the chamber as either a board member or an ambassador, please stand and be acknowledged. We also want to thank and acknowledge our sponsors for this morning's breakfast. Our sponsors play a critical role in the forecast series and really everything we do. They help us keep the prices reasonable, which is not an easy thing to do in today's economy, but we really appreciate all the help and support we get. Our diamond sponsor for the entire forecast series is Clark Hill PLC. Thank you very much. Our platinum sponsor is Bank of Ann Arbor. Our gold sponsor is Fenner, Mellstrom, and Dooling. And if you fueled up this morning on coffee, our coffee sponsor this morning is Doug Hopkins. So thank you very much. I almost said Douglas. So thank you all to our sponsors. So our moderator this morning is Joseph McCarthy. Joe's an associate attorney for Clark Hill's Birmingham office, where he advises a broad range of businesses and nonprofit organizations on matters such as formation, corporate structure and governance, mergers and acquisitions, general commercial transactions, and contract negotiations. Joe graduated magna cum laude from Michigan State University College of Law and also holds a degree in political science and government from the University of Michigan. Following our presentation by Paul Traub, we will have some time available for a question and answer. You should all have index cards on your tables. Just jot down a question, and chamber staff will be by to pick them up, and we'll do a little facilitated Q&A. So at this point, I'd like to introduce Joe to the podium, who's going to introduce our speaker.
Thanks, Joe. So I'm here to introduce the first speaker today. Paul Traub is currently an economic consultant for America's Commercial Transportation Research Company, or ACT Research. Previously, he was the chief economist for ACT Research, was senior business economist at the Detroit branch of the Federal Reserve Bank of the Federal Reserve Bank of Chicago. And he was also an economist with Chrysler LLC. He ended his tenure there as chief economist. Traub was adjunct faculty at Oakland University in the School of Business and served on the advisory board for Oakland University, Baker College, and Lawrence Technical University. At the Fed, Traub co-created the Federal Reserve Bank of Chicago's Detroit Economic Advisory Index and was a frequent contributor to the Midwest Economy and Michigan Economy blogs. He holds a BBA from the University of Michigan Dearborn and an MBA from Oakland University. Please join me in welcoming Paul Traub.
All right. Thank you so much, Joe, and it's great to be here. Some of you have probably seen me before, so I won't hold that against you. I do have some public service announcement. If you're not going to eat your eggs, they want to put them back in the shells so they can resell them. So just there'll be someone collecting them as we go along. Okay, I'm going to try to move pretty quickly because I want to save time for Q&A. Everyone can hear me, I think. I have another microphone if I need that. I think I have like 3 microphones, so it's going to go well. I'm going to go pretty fast. This slide is really for me more than you, so I remember what I'm going to do. I always talk about the economy, C plus I plus G. Anybody here take economics in school and know C plus I plus G? consumption, investment, government spending, net exports. You add that all up and you get GDP, which is the best kind of way to follow the economy. We'll talk about that and how it performed last year. We got all the data, at least the preliminary data for the fourth quarter. We can go into that in some detail. I also will talk about the ability and willingness of consumers to spend money. Consumers make up about 70% of the economy. When I was at the auto industry, I would call them the stoplight indicators. They were red, green, or yellow, and we'll go into them in some detail, especially the ones that I think that are important. I'm actually going to also kind of go back in time a little bit, back when I was young, and kind of do some comparison of data from back in time to where we are today, because the world is changing, believe it or not. Believe it or not, the world is changing. Is that better? Okay, maybe I should use this. Yes, is that better? Okay, my arm's going to get tired. We'll talk about business conditions and activity. I'll talk a bit about the oil markets and the energy independence, which is part of the drill baby drill. Immigration policies, which are being proposed. Tax and tariff policies that are being proposed, and what impact they may have on the forecast that I'll be presenting at the end, after we talk briefly about monetary policy, which I know a little about after spending 10 years at the Federal Reserve. So to start off real quick, a thumbnail sketch of how the economy did. The fourth quarter grew by 2.3%. The bars in that quarter and the little table below show their contribution. So it's not their percent change on a year-over-year basis. It's how much they contributed, each of them, to add up to the 2.3%. And you can see over here on the right side, I break it down into the subcomponents. On the top, you can see that, I believe this is a pointer. Personal consumption is the biggest part of the economy and did the most. People are spending money and continue to spend money. It's been doing quite well. We look at the gross private domestic investment piece, which is residential, non-residential, and inventories. You can see inventories fell, and non-residential was a negative contributor to overall to the quarter. We look at exports and imports. You can see that exports were down, imports were up. So that's going to be a negative because you're going to have a more negative contribution from net exports. And federal government continues to spend, state governments continue to spend. When you look at it on a year-over-year basis, the economy grew by 2.8%, which is quite strong for the U.S. economy. It's the strongest economy in the world. And we can see that personal consumption accounted for 1.9% of that, 2.8%. So consumer continues to drive. When you break it down, you can see services being a very large part of that. We'll go into that in a little bit of detail. Services is what drives the economy today, rather than purchase of goods and durable and non-durable. Gross domestic investment contributed 0.7. Net exports was negative because we imported more than we exported. And we see government continues to contribute overall to the economic growth. I mentioned services as being such a large part of the economy. So when I go back to my youth, when I was about 9 years old, back in the 1960s, you can see that we actually bought more goods than we did services. Services were a smaller part of the economy. But we still had more service employees. Because service workers aren't as productive as what we were able to do with manufacturing and other kinds of things, to automation. So we have, as we move forward through time, by about the mid-70s or so, we start to see services being the largest portion of the overall economy. Goods fall off. When you look at the employment, it accounts for over 85% of all employment is in the service area, and roughly 15% or 13.7 if you want to use the big numbers. Is what we do for producing all the goods that we produce in the U.S., manufacturing, mining, engineering, those types of things. We look at the services from exports. We export both services and goods. You can see that there's definitely a disconnect between what we export in goods and what we import in goods, but we actually export more services. We have a positive net export for services than we do import of services. We looked at residential construction, as I showed, that the data in residential construction, the housing industry has really been struggling, it's been slow in coming back, and we look at the data shows that it would be declining. So it should be a negative contribution to overall. You would expect that the residential fixed investment would have been negative year over year if you look at that. But what we ended up seeing was residential real structures and improvements. People are staying in their houses longer. That's been part of the problem with their industry. People don't want to sell their house because they either have now with high interest rates, they got to spend more money of a payment each month, and house prices are so high. So people are deciding to stay where they are. In fact, my wife keeps telling me, would you stop putting money into the house? Because we should be wanting to leave here at some time. And I keep telling her, well, but we want it nice. So we keep putting more money into the house, and that's what Americans have been doing. And you can see it actually grew by $276 trillion, 8.6% year over year, set an all-time record on money spent in a year for fixing up your home. The indicators, consumers, these are the stoplights, red, yellow, or green. Red means bad, yellow means cautionary, and green means good. Real disposable income is very important. This is what drives consumption. People have to have money to spend to drive consumption, but they have to want to feel like spending that money. So the ability and the willingness. I could have money in my pocket, be not willing to spend it. So when consumers get uncertain, they don't want to spend, that can contract the economy no matter what their financial condition is in. Interest payments eat up portions of your disposable income as you pay interest. So we watch that, and it's starting to come back. It was lower, it rose in the middle of the year, and started to come back. Inflation was dropping, but we've seen a slow uptick more recently. The yield curve is the only index that is actually predictive. Whenever the yield curve is inverted or negative, meaning the cost of money on the short term is higher than the cost of money on the long term, usually predicts a recession coming because banks don't want to lend. It costs me more money to borrow the money. If I borrow it long, lend short, interest rates get too high, people don't want to borrow, it contracts the economy. So that's turned positive, and we'll talk about that. So the composite is yellow. Consumer attitudes fell. They were doing well starting out the year, but then, of course, the heat of the election, everybody calling everybody else an idiot, doesn't help people feel comfortable. So we turned around with a negative downturn. It started to turn around as it looked like we saw who the winner was going to be. There was a bit of irrational exuberance here in November as people said, oh boy, we won. And now we're starting to see that turn back around as policies are starting to take hold and people are starting to feel some effects. Initial unemployment claims, it shows you whether or not people are being laid off, and if they're not, if that's below 250, they're strong, and that's really good. So unemployment claims are low. Manufacturing hours above 40 or 45 means that people are working. This includes part-time and full-time. People are getting overtime, and that's a very positive thing for income generation. Stock market is booming. It has taken a couple months of setback, but it's still well above where it was to start the year. And we've got that composite on yellow. So it's cautionary right now for the consumer. As I mentioned, personal income is so important. You can see here personal income growth over a long period of time. We're finally just below where it was. This is all the incentive money from the coronavirus. That's why the negative is so bad, because we sent out a lot of money to households, which we'll talk about. But look at where it was when I was young, when my dad was taking care of the household in the 60s and 70s. Real disposable income, after adjusting for inflation, was up over 4%. At 3.5%, which was here, I always like to talk about the rule of 7. If I have a fixed rate security growing at 7% per year, it's going to double in value every 10 years. So I got real disposable income growing close to 5% or over 3.5%. My dad's position in life changed within 20 years. He went from being, starting guy to being able to buy a house, being able to buy cars, being able to put my sister through college. That was a change. And this change now we're seeing now with real disposable income growth falling and falling and falling, been falling for decade after decade, is where we're seeing more disgruntled households, more people seeing we're not getting ahead, because they're not seeing the kind of growth and the opportunities that were presented in decades earlier. We look at real disposable income growth, and it tracks what's going on in spending. I get more money, I spend more money. In fact, right now, households are spending roughly 91%, almost 92% of the money they bring home as disposable income on consumption. In the housing and utilities part is taking a bigger and bigger share of it. as people are buying homes, and you look at the real estate, and you can see how it kind of back here, it kind of all of a sudden it ramps up. Look here in the most recently, because in that would also include the interest you pay on your loans, and that's really shot up. So more and more of people's money is going towards the service part of the segment, just to service their loans on their house and do some improvements, put in new drapes or things of that nature. During the pandemic, we had a tremendous growth in the M1 money supply, also known as the narrow money supply, which resulted in a tremendous growth in household checkable deposits and currency. Now, it's not equally distributed amongst everybody. Some people have more than others. But this is the wealth that's keeping the economy going. People have a lot of money out there to spend. Maybe not you and I, but there are people out there with lots of money to spend. It was injected in during the American Rescue Plan, a tremendous amount of money, and what that has happened, and what people say, well, it led to inflation, right? People spend more money, too few goods, too much money, you got higher inflation. So you can see inflation shot up, consumer price index starting to fall, and it's starting to turn around. Starting to go higher again. That's why the Fed has held off on doing rates, and we'll talk about that hopefully if we get time in a minute. You can see when you break it down into the components, food was high, energy was high, but it's coming down. But look what happened to energy most recently, as talks about putting tariffs on imports. We import a lot of energy. So people are getting worried, so energy prices are rising, and if you threaten energy companies, they're going to raise their prices, and they have, and you can see that going on. And we can see transportation is coming down, but we saw a most recent jump in transportation because of energy. Look at durable goods, non-durable goods. Durable goods prices should always be falling. We're always figuring out a way to make them better, right? We're always figuring out a way to cut costs. We're always figuring out a way to outsource, or however we do it, to make durable goods less expensive, and that's back to a negative trend, and that's really good. Non-durable goods were negative, falling back a little bit for a few months, but look at the most recent, and that's got a lot to do with what happened to energy. And of course, services, everyone knows, has been a problem, finding service workers, paying the wages, and service costs have been going up over time. We look at consumer prices, and I break it down over back to 2 years. You can see we're back. It's starting to fall. But look at where it was when I was young. Remember, I said in 1970, real disposable income grew by almost 3.5%, or 5% in the 70s, 3.5%. You guys remember it probably better than I do. That is on top of inflation. So what were wages going up? Wages had to be going up 10%. 15% in places. And our friend, anybody remember Richard Nixon? He's best known for, I'm not a crook, right? He decided he was going to do something controversial, so he signed an executive order to put a 90-day freezes on wages and prices. And then a year later, he signed a tax cut to give money back to people, because he found out that wasn't going very well. If anybody lived back then, you'd know he took a lot of heat for that, trying to freeze wages, ended up having to back off on that. So when you do these kinds of executive orders, they have consequences, and sometimes you have to walk them back, and we'll see how that works going forward. We see personal interest payments. Again, interest rates rise, percentage of your income goes to interest payments, a larger and larger point. I said the yield curve is now positive, which is great, but we look what's happening most recently with the 10-year Treasury bond. As yields go up on the Treasury, that means going to have higher mortgage rates, more cost again for that, so it's kind of a double whammy. It brought the curve back, which is good for lenders, because I borrow short and lend long, so now I have a spread that I can make some money. But again, interest rates are still high and could be a headwind for economic growth. And that's showing up in consumer attitudes, which fell drastically during the pandemic. We're starting to come back, and most recently it turned around, and there's your hourly working, which is starting to come back. So here we are at a time when things are really starting to kind of turn in the right direction. Manufacturing is working, manufacturing picking up, as you'll see in a minute, and we're starting to see some headwinds coming in the form of tariffs and things of that nature. Stock market took off, and so did household net worth. However, household net worth isn't so evenly divided. The top 20% control about 60% of all the net worth, and the top 1% control 40% of all net worth. So that's that wealth distribution that you hear so much about, and it's the same thing when it comes to income. Look at businesses. Look on the green side on conditions. They're making money. Their debt ratios are great. The risk premiums are low. You're looking at producer prices were falling, and all of a sudden now we're starting to see producer prices start to rise on fears of tariffs and costs for goods and supplies that are going in. We're also starting to see what's going on. The Purchasing Manager Index was just starting to turn around. It had been negative, turned red, and then started to turn positive again. When it's above 50, that means it's expanding. Manufacturing is expanding. Just turned positive again for the recently, which is very good. Capacity utilization, it's okay. Industrial production was starting to come back. But the real struggle is new orders haven't been in there. And inventory stayed down, new orders stayed down. If you don't build, you don't have inventory, you can't sell, you end up with higher prices. So that's not good for inflation. When you look at the risk premium, you can see it's lowest it's ever been in these hard times. I'm wondering why the risk premiums. Markets don't feel that there's a problem with the economy. The market thinks the economy's strong, and the economy is strong. It grew 2.8%. So markets feel that the economy's strong. There was no risk premium for businesses, and businesses continue to operate because they have a tremendous amount of capital that they were able to acquire through the high profits brought on by tax cuts in 2017, 2018. You can see at the corporate bond rates, though, continue to rise, but the spread remains positive. Producer prices, again, as I pointed out, starting to rise. You can see where they're rising. If you look at the pieces, manufacturing is starting to see rising again in some of the equipment and stuff that they need, construction and manufacturing, but we got green, but still producer prices are starting to go up. New orders, which have been struggling, this is adjusted for inflation. So that you got to adjust it for inflation, because if I'm ordering widgets, right, I get on 10 widgets and they cost me 10% more, I'm still producing 10 widgets. So the price of those widgets go up, but you're producing less, right? And that's what we've been trying to get out of. And that's where we're starting to see that turnaround most recently. It was starting to tick up. We've had the two strongest quarters of growth in new orders that we've had dating back to May of 2020. We're starting to see total business grow up. But however, now we're starting to see producer prices rise, which could continue to rise. So this to me is kind of a cloud on the horizon as what we see going further into the year. You can see what the managers are saying, 15.9 positives, it's strong across the board. New orders are strong, production strong, employment strong. We're just starting to turn around after periods of negative. So just starting to see that turn around. Hopefully we can keep that going. We look at oil prices and elasticity. So this is kind of talking about energy independence. We are energy independent. We actually export more energy than we import. We import energy because of location and logistics. It's better to bring some oil into the East Coast by ship so that we can refine it there. It's better to bring some oil into the West Coast by ship because you can refine it there. It keeps the cost down. And energy prices are not set by an individual country. They're set by global prices, supply and demand. So you can't really drill, baby, drill, do whatever you want. It's not going to change the price of energy. If you bring it down, you're going to run into some problems. And then we'll talk about that in a minute. Here's you got your gasoline and oil directly correlated. I love to throw in a regression model in. Don't I do a regression model every year? It's just so you guys can look at this and say, boy, he's smart, but you know. What it tells you is that for every $10 increase in the price of oil, a gallon of gas goes up 31 cents. Right? This used to be, when I was in the auto industry, it used to be 25 cents, but with labor going up and other kinds of costs, it's actually risen that. This is what I'm saying about oil and drilling. To new wells, $70 a barrel in some of the most productive areas in the country. So if I have to drill a new well, I have to sell that oil for $70 a barrel. That's what it's selling for today. Old wells, I can sell it for less, right? So creating more oil is going to be more expensive, and you're not going to be able to bring down the oil prices just by raising the supply because there's going to be a cost issue. We're looking at foreign-born workers. There's a lot of concern about what's going to happen in the immigration stream. They make up very large percentage. You look up the share of the unauthorized workers, about 18% of the total civilian workforce is not unauthorized. About 4 to 5% are unauthorized, but they're foreign workers. But you have to concern yourself with, if I send my dad home and my wife can't, does she go with him, and she's legal, right? So we look at what's going on from foreign-born workers. You can see down here, this is why we like them. They'll work for $987 a week compared to $1,100 and $40 for somebody domestically. They're cheap labor, right? So they bring them in for cheap labor. Well, I take all that stuff that I showed you earlier, and I take the data, and I take that 97, and I multiply it times 45 weeks. They generate about $44,000 in income. If they spend about 90% of that after taxes, they spend about $300 billion. Roughly 1.3% of total GDP, and they add about $60 billion to income taxes or taxes for the government. They are an initial and a good part of the overall health of the economy. Proposed tax reforms. These are the cuts, the proposed cuts. Total $10 trillion over the next 10 years in cuts. Is what's being proposed. These are the additions. We're going to get rid of the green energy credits, so who cares about the air? And we're going to impose tariffs on all imports plus 50% on China. We're going to generate roughly $380 billion a year for the next 10 years in taxes on the consumer that it's going to go towards paying for the deductions. And we're still going to have a net deficit of almost $6 trillion over the course of the next 10 years, which is going to increase the potential by 2065 of GDP to debt ratio to over 220%. Not a good thing. It's going to add 2.4%, but when you look at the imports and the tariffs and what it's going to do to consumers and spending, it's going to take away 1.7. So a net plus about 0.8%. But gross national product, which includes imports, is actually going to be negative. So companies that are working, U.S. companies that are working abroad are actually going to be losing money. We look at custom and duties. This is what happened the last time. So we put in tariffs the last time. You see a big spike this is the weighted tariff rate, 13.87. It spiked way up with roughly $20 billion in tariffs. But quickly came down as manufacturers found ways to get around it. And they did. They found ways to either bring some of that home, or a lot of it went from China to Vietnam, or China to Indonesia, or somewhere else. And they found ways to get around it. But if you put tariffs on everybody at $380 billion a year, it's going to be a lot harder for these companies to figure out loopholes and backdoors to get around them. And so a larger percentage of that money is going to be passed on to the consumer. We've been able to import. One of the good offsets is the strength of the dollar. So that offsets some of the tariffs in that a strong dollar allows us to buy more stuff from overseas, but you put more tariffs on it, it's negating your dollar strength. So this is the tariff hikes. So what's planned? So these are the Trump tariff hikes and what it's going to do to the overall economy. You can see, and now over here is the change in after-tax income. So tariff hikes are going to negate any kind of income growth for the bottom half of the country. Top half of the distribution is going to see very large gains in income. Bottom half of which is kind of where I'm sitting now, is going to see the worst. I imagine everybody in the room here is probably somewhere in this area. So you're going to see some net gains in income. The problem is you're going to see a lot of people, 50% of the population, that produce and buy in goods, personal consumption, seeing a decline overall in income over the next 10 years. And then we did the trade war. Now I'm quoting the Wall Street Journal here, okay, so just trust me, I'm not trying to be anti anything. February 3rd, the dumbest trade war in history. We took and put tariffs, we were going to put 25% tariffs on $500 billion of trade with our closest neighbors, our nearest friends, people that have supported us in every domestic or international conflict we've been in. We were going to put tariffs on them, and we'll only put a tariffs on about $130 billion of stuff. It comes to risk, because you're going to see reaction to your tariffs. So we put tariffs on them, and you're sending them $500 billion worth of goods. Sure, there's a trade deficit, but you're sending them $500 billion worth of goods, which they'll put tariffs on, right? And then you turn around and you're buying a lot from China, but you're only sending them 130 billion. So you're trading 500 billion that could be tariffed back against 130 billion that you're going to do to China. It just doesn't make sense. There's no logic in it, in my mind. And what is it going to do? At average, this is my calculation, about $1,500 to $1,600 additional cost per household. It's going to push inflation up from where it is now, an additional 3.7%. So if you're at 3%, you're at 6.5%. And then once the prices change, then things will go down, but there will always be about 0.1% growth in inflation going forward. Monetary policy, I always like to say, is we use maximum employment. How am I doing on time? Am I okay? Maximum employment and price stability. So this is, I'll put on my Fed hat because I always like working for the Fed. That's the dual mandate that's mandated by Congress. This is where the information that's coming out now out of the new administration about lowering interest rates themselves and not letting the Fed do it find me scary, because now you're talking about the independence of the Fed. The Fed needs to remain independent. And I'm going to make that comment, and I'm going to stick with it. The Fed needs to be independent and the ability to do its work, because it's done a marvelous job in controlling inflation over time, and it's done a great job in keeping the economy streaming along nicely. So price stability and maximum employment, and that's what they're working for to create a growing economy. And we've had a growing economy. This 2023, 2024, this is final demand. So I take out government and net exports. I'm looking at investment and consumption. Final demand in the U.S., and you can see it's been growing and averaging 3.2% a year, growing quite strongly, 3.2% in the fourth quarter, and it's actually above the long 10-year trend. The economy is doing well. That's why we're the strongest economy in the world, and we're doing well. Why would we want to upset that apple cart? We look at employment. This is the reason why I don't think the Fed's going to move very quickly. So if everybody's waiting for the next interest rate cut, you might be waiting a little longer than you had planned. Employment is coming down. That's what the Fed's trying to do. They're trying to slow down employment growth because that slows down wage growth, which slows down inflation, and they're doing a pretty good job. 164,000 jobs average per month in 2024. Not a bad number. Not a bad number. We add about 125 to 200,000 people to the labor force every month. And the unemployment rate, actually, even with the 143,000 jobs, came down to 4%. The unemployment rate came down to 4% in the most recent numbers. And we hire a lot of people in the service industry, right? So the service industry is coming back or staying strong, and that's where most of the jobs go. Some in manufacturing. Whenever I see manufacturing, construction jobs added, that's a good thing for the economy, even if it looks like a small amount, because they're a very small percentage of the overall labor force. So personal consumption expenditures is what the Fed looks at. And so what we see here is things were coming down, things were getting great, and all of a sudden, worries start to hit, supply constraints start to show up, inflation starts to rise in the personal consumption expenditures. You can see durable good prices falling, non-durable goods jumped up 0.5%. Services are actually starting to come down. So in all, it was starting to do real well. I'm fearful of what might happen if we impose more tariffs and more actually taxes on individuals, what that's going to do with inflation, and how that's going to impact the Fed's ability to lower interest rates on the short term. These charts here, every one is the orange bars is the highest probability of where the federal funds rate will be at the end of that period of time. And right now we're at 4.25 to 4.50. If you go down here, 4.25 to 4.50. You start to see 400 to 425 not until September. And you don't see another one in the rest of the year. So it looks as if we may just see only one rate cut this year. And Jerome Powell said just yesterday, because the economy is doing well, the Fed can take its time to decide when or whether to lower interest rates. So he's basically telegraphing to you, because I know Fed speak. He's telegraphing to you, hold on to your hats, because it's not coming anytime soon. The economy's growing, and I think it's going to grow. I'm quite optimistic that it's going to continue, but there are going to be some headwinds we'll talk about in a minute. I think that it's going to grow about 2.5% this year, which is kind of consistent with the blue chip. The blue chip has got a high of 2.9. The forecast coming out of GDP now is 2.9 for the first quarter as of January, so I'm kind of doing there, and it's going to start to slow down as we go forward. And we could see a bigger trough later in the year if the tariffs and other things have more headwind than I expected. So U.S. economy remains strong, driven by consumer spending. Ability and willingness composites remain on yellow, as high prices and fear of higher tariffs have lowered consumers' attitudes. It's actually mentioned in the most recent Michigan survey, and it's been one of the reasons why things fell back. Business contingent activity and conditions remain on yellow. Borrowing costs remain elevated. Manufacturing orders are continuing to struggle, and hopefully we'll get out of that doldrum. Projections for the economy remain positive, 1.5% to 2.5%, depending on how you talk to over the next couple years. What we're seeing, though, is people pre-buying. So you're going to pull some of that forward. People are pre-buying. I don't know if you've seen any of the ads, people in the stores buying avocados or buying stuff, you know. They can't find an egg, right? But pre-buying in fear of what's going to happen if the tariffs are put on. So if I buy today, I don't need it tomorrow, right? So you could see some pre-buy, which actually helps elevate the first quarter, and then you end up with a bigger trough later on. That continues. They're going to hold steady. Probably just a single rate. And the key risk to the forecast, higher tariffs, renewed supply chain problems with higher tariffs, immigration policies, pro-oil policy, Fed independence, tax policy, budget deficit, and the AI race with China, not to talk about the geopolitical problems we have around the globe. How'd I do?
You did fine.
Okay, thank you.
We have a couple questions.
Okay.
So we have some questions for Paul before we finish up today. First question, Paul, we're wondering if it's even possible to forecast where our economy is headed given the level of uncertainty we have currently in Washington.
No. You want more? I'm just saying there's risks. I think the economy's strong. I think everything is there. Why upset the apple cart? Things are going well. If we keep that going, we could see a very continued strong. We should go back towards trend. What's trend? Is it 2.5%? Is it 2% economic growth? But we should be able to slowly glide back to that as we go through the normal business cycle, unless we upset the apple cart with some of those challenges I pointed out.
Our second question, you touched on it a little bit, but it's about the tariffs. We're wondering who really benefits from tariffs like the ones being threatened currently.
Nobody. Nobody. I mean, basically what the administration is trying to do is go back to the early 1900s, 1800s, 1700s, when we paid for our federal government through tariffs. That's how we financed the government. And we're going back to that period of time. Tariffs are a tax. I don't care how you put it. Yeah, if I take your income tax and make it to zero, but I tariff everything else, so I have the 7 or 8 whatever trillion dollars I need to run the government, you're paying that tax. So tariffs are a tax on the individuals, and I can lower your income taxes all you want, but they're a highly regressive tax. They hurt the lower income people more than they hurt the upper income people, and that's why you saw negative income growth for the lower income people down to the top, all the way down the first half of the population. So 50% of the people will see negative income growth if all these tariffs and taxes are put into play.
State governments have swelled from the lingering benefits of ARPA funds. What do you think will happen next year when all that money is gone?
Well, our governor talking about the slush fund, trying to save money to do roads. If funding from the federal government that goes to the states, which we use for schools, which we use to build roads, which we use to do other things, goes away, then yeah, the federal deficit could go down, or they could lower that spending, but the states are going to have to pick it up, right? I mean, it's take from Peter to pay Paul. So you're going to see maybe higher gas taxes. You'll see higher, maybe you might start bantering about bringing up the sales tax higher, like you see in some other states. Ways to generate revenue so that they can provide services. The whole plan is to monetize and take public goods and quantify them in a way in which we can sell them, right? And we make money. So I can take something like healthcare and I can quantify it. I mean, in a country as wealthy as we are, to have people dying in cars at the most recent incident that happened at the MGM Grand, because they're living in a car and it's 17 degrees outside and 2 children died because they don't have a home. I'm sorry, it just doesn't, it boggles my mind. So you're going to have to take from Peter to pay Paul.
Last question this morning is from a member of the audience. He's wondering what do you think the effect will be on our auto industry as China absorbs a larger portion of the global auto market share?
I had a good talk earlier about what I think the auto industry is doing. I think the auto industry has positioned itself away from market share towards marginal cost equals marginal revenue. I can sell a product if I know how much it costs. The uncertainty of tariffs is I don't know how much it's going to cost. But if I know my cost structure, I know how to price it, and I know who I'm going to sell to, then the auto industry is kind of positioning itself in that way. That's why the electric cars, I think, are going to happen. They got to happen. As much as we say we don't want them, they're a platform in which the auto industries can set up a model in which they can be profitable. They have a basic platform that's electronic. Remember the old cars had 112-volt battery. The electronics in a new automobile are tremendous, and you're going to sell people updates to the software. You're going to sell people access to the internet. You can sell people access to radio. You can sell people a lot of things so they can make money on subscriptions, but they can also set a volume level that's going to be profitable based on their costs. They just have to know what those costs are.
Thank you, Paul.
All right, thank you. So what did we decide? Paul, we were trying to figure out how many years you've been doing this for us.
I think since I was 12.
He's the only economist I've ever met who has a sense of humor, so that's why we keep bringing him back. Otherwise, it could be a pretty dry topic.
I think you said 13 years.
I think could be 13 years. So thank you again. Thank you to Joe McCarthy for moderating today. Thank you to our sponsors. Thank you all for coming. I do want to make one programming note before we do our giveaway. In exactly 1 month from today, we'll be right back in this room for our real estate forecast. Our real estate forecast is always the largest attended of the 3 forecast series we do. It sells out every year. So based on the crowd this morning, if you're planning to attend the real estate forecast, my suggestion to you is make your reservation early, particularly if you want to secure a table. So just keep that in mind. And then our final forecast will be on technology, where we're going to delve into the practical use of artificial intelligence to help grow your business. So 2 more great things done. Again, thank you all so much. Hopefully you enjoyed this morning's program. If you like what you saw, I'm not going to say if you like what you heard because it's kind of a mixed message, but if you like what you saw, and if you have somebody in your sphere of influence who you think would benefit from joining the chamber, please give us a call and we will help make that happen. So have a great day.